You know, when you look at a truly massive, towering skyscraper, your eyes are just naturally drawn upward.
Right.
You look at the sleek glass, the modern design, the way it catches the light at the very top. It's shiny, it's new, and it's basically what everyone walking by on the street is actually talking about.
Yeah, the penthouse gets all the attention.
Exactly. But if you actually want to know how long that building is going to stand, especially when, a major storm rolls in, you don't look at the penthouse.
No, you definitely don't.
You have to go down into the basement. You have to look at the concrete, the steel rebar, the foundational bedrock. It's not as glamorous. I mean, it rarely makes architectural digest. But it's literally the only thing that actually keeps the whole structure from coming down.
That's the perfect mental model for what we are doing today. The foundation isn't the part a company usually puts on the glossy front page of its investor brochure, right? But it dictates the physical reality of the entire building.
Yeah.
If you misjudge the foundation, you basically misjudge everything above it.
And that brings us perfectly to the subject of today's deep dive for you guys. We are looking at a company that is an absolute titan in the financial world. You might think, Moody's trading under the ticker MCO, but we're looking under the hood today.
Deep under the hood.
Right. We're not just, reading the corporate brochure or the PR spin. We are examining an incredibly extensive, detailed AI investment memo. This is dated May 19th, 2026. And the mission for this deep dive is very specific. We're applying a highly skeptical, really rigorous framework to a company that seems to almost everyone just fundamentally unshakable.
Which is precisely why this level of analysis is so necessary. I mean, when a company achieves the kind of elite oligopoly status that Moody's enjoys, where they essentially own the market alongside one other major player, investors just have a tendency to stop asking the hard questions.
They get complacent.
Exactly. They assume the past guarantees the future. So our goal today is to separate the hard financial facts from the corporate narrative. We're going to look really closely at whether the market is overvaluing the company's transition into a modern software and data business, while perhaps conveniently ignoring its deep foundational dependency on the highly cyclical ratings market.
That is the classic tension we have to resolve for you, the listener. We are looking at an undeniably elite, high-quality franchise. But just because a company is great doesn't mean its stock is a great buy at any price.
Right, price matters.
It always matters. So we have to figure out if it is a sound investment at its current entry price. Let's start right there with the core identity of this company, because looking at this memo, it feels like Moody's is living two entirely different lives right now.
A bit of an identity crisis, yeah.
Yeah. If I'm an investor looking at a 5, maybe 10-year horizon, I'm trying to figure out what kind of animal I'm actually buying. Are we looking at a high-growth tech company, or are we looking at a traditional financial gatekeeper?
The reality is that they are operating as both. But the stock market desperately wants to price the entire entity as just one of them.
Because one is a lot sexier than the other.
Exactly. Let's look at the actual numbers from their 2025 operating model, because the data just reveals a profoundly bifurcated reality. Moody's essentially has two main engines driving the vehicle.
Okay, let's break those down.
First, you have Moody's Analytics, which they refer to as MA. In 2025, MA generated $3.6 billion in external revenue. And the crucial detail there is that a staggering 96% of that revenue was recurring.
Wow.
Yeah, it's subscription-based software, data feeds, and research.
Let me just pause you there, because that 96% recurring figure is like a magic word on Wall Street.
Oh, absolutely.
Investors love predictability. You wake up on January 1st, but before you've even had your coffee, you already know what 96% of your analytics revenue is going to be for the entire year. That is a dream business model.
It is the absolute holy grail for corporate valuation. But we have to look at the other engine, right? The historical core of the company is Moody's Investor Service, which is actually recently rebranded as Moody's Ratings, or MIS.
Okay.
That side of the house generated $4.12 billion in external revenue in 2025.
So on the top line, just looking at pure sales, they look roughly balanced. You've got $3.6 billion for the analytics software side and $4.12 billion for the traditional rating side. They look like equal partners.
On the surface, yes.
Right, but when you move further down the income statement, the profit story is just completely lopsided.
It is astonishingly lopsided. When you look at the segment adjusted operating income for 2025, which is essentially, the actual profit generated from the core operations before taxes and certain other expenses, The analytics side, MA, brought in roughly $1.2 billion.
Which is nothing to sneeze at. I mean, $1 billion in operating profit is massive for a software business.
True, true. But compared to the ratings side, MIS drove about $2.75 billion in adjusted operating income. Yeah, so the lion's share of the profit, the actual fundamental cash-generating power of the enterprise, is still overwhelmingly coming from the traditional ratings agency, not the recurring software side.
Even though the software side has all that locked-in recurring revenue.
Right. And yet, if you look at the entire company-wide revenue, it's split about 63% recurring and 37% transaction-linked.
Okay, let's unpack this. I really want to highlight this dynamic because it feels like the crux of the entire investment narrative here. It's like looking at a highly profitable old-school toll road, but the market is pricing the entire operation like a high-growth tech startup just because they added a subscription fast lane.
That's a great way to put it.
The physical toll road is where the actual money is being minted right now, but everyone is staring at the digital fast lane because it looks like the future.
That analogy captures the tension perfectly. The core business reality, the bedrock of that skyscraper, is that Moody's is an elite oligopoly ratings franchise that just happens to have a very high-quality analytics arm attached to it. It is not the other way around. It is not a disguised, pure-play software-as-a-service company. And this distinction is everything when it comes to valuation. The stock market often awards Moody's what we call a premium data services multiple.
Okay, for listeners who might not spend their days staring at Bloomberg terminals, let's ground that concept real quick. What does giving a company a premium multiple actually mean in plain English?
A valuation multiple is essentially how much investors are willing to pay for $1 of a company's earnings.
Right.
So if a company is in a highly cyclical, unpredictable industry, like, say, a steel manufacturer or a traditional investment bank, investors might only pay 10 or 15 times earnings because, next year's earnings could fall off a cliff.
It's risky.
Exactly. But if a company is a pure software business with locked-in recurring subscriptions, investors might pay 30 or 40 times earnings because that revenue is considered incredibly safe and durable.
So the market is looking at Moody's, seeing that sweet 96% recurring revenue in the analytics division, and basically slapping a massive software multiple on the whole company.
Yes. They price it as if its overall consolidated earnings have the predictability and durability of a pure software business. But the bulk of the actual profit at Moody's still comes from the ratings engine, and ratings are highly cyclical.
Right, they go up and down.
Ratings revenue is tied entirely to debt issuance activity and deal timing.
Let's explain the mechanics of that for a second.
Yeah.
Why does debt issuance fluctuate so much? Don't companies always need to borrow money?
They do, but the cost of that borrowing changes dramatically. When interest rates are low and the economy is booming, companies issue a massive amount of debt to fund expansions, buy competitors, or even just buy back their own stock.
Because money is cheap.
Exactly. Money is cheap. And when companies issue debt, they legally, or at least practically, need a rating from Moody's or S&P to sell those bonds to institutional investors. So in those environments, Moody's makes an absolute fortune.
But when the music stops...
Right. When the Federal Reserve raises interest rates dramatically or credit markets freeze up during an economic panic, it becomes very expensive to borrow. So debt issuance plummets. And when issuance plummets, the revenue from Moody's ratings segment falls right alongside it.
So if an investor underwrites Moody's as a pure recurring software company, comparing it to something like a FactSet or a Salesforce, they are functionally overstating the durability of its earnings. They are putting on blinders to the cyclical reality of the toll road.
Exactly. You are pretending the cyclical part doesn't exist. But to be fair to the other side of the bull argument, if you evaluate Moody's strictly as a traditional ratings agency, you're missing the boat in the opposite direction.
How so?
Well, if you only focus on the cyclicality of debt issuance, you deeply understate the phenomenal quality, the stickiness, and the growth of the analytics arm.
So it's a tug-of-war.
Very much so.
The business that makes Moody's look incredibly subscription-like and predictable, the analytics division, is not yet the business that most determines its bottom-line profitability. So what does this actually require of the company? I mean, if the market is pricing it at this premium, it feels like they are walking a tightrope without a safety net here.
It creates a scenario with very little margin for error. For the stock to actually justify its current premium valuation, we infer from the memo that 3 distinct things have to happen virtually flawlessly.
Okay, let's hear.
First, Moody's Analytics must continue to compound its recurring revenue without stumbling. It has to keep growing at a high rate.
No slowdowns allowed.
None. Second, the macroeconomic environment, specifically interest rates and credit spreads, cannot stay hostile long enough to materially crush rating volumes. The cyclical engine has to keep humming, or at least revert to the mean pretty quickly.
And what's the third thing?
Third, the new growth pockets the company is aggressively pitching to investors, things like private credit expansion and artificial intelligence, must actually add real, durable, economic value. They cannot just be narrative excitement meant to prop up the stock price.
Narrative excitement. That is a very polite Wall Street way of saying hype. I love that.
It is.
So to understand how Moody's built this incredibly complex dual-engine machine in the first place, we really have to look backward. I mean, how did a century-old credit analysis firm become a software and analytics giant? It didn't happen overnight.
No, it took years.
It really comes down to monetizing trust. So let's dig into the historical pattern recognition here. Why does the track record of this management team matter so much when evaluating their pivot to what they now call an integrated risk platform?
History is often the best and sometimes the only way to gauge a management team's capital allocation discipline. You have to remember the legacy here. This franchise traces its roots all the way back to John Moody's original credit analysis business in the early 1900s.
A long time ago.
A very long time. For decades upon decades, the company was purely about public ratings. They evaluated bonds. But the modern iteration of the company has spent years aggressively broadening that legacy into data, workflow software, compliance tools, insurance risk, and even climate-related analytics.
So the relevant historical question isn't just whether the brand is old and respected, it's whether the people currently running the show have proven they can repeatedly extend a trusted ratings brand into adjacent risk products without ruining the core economics.
Exactly. Have they diluted their credibility by wandering into areas where they don't belong, or have they built a wider, stronger moat?
Well, looking at the timeline provided in the memo, they have been on an absolute shopping spree over the last decade. But it looks deliberate. Let me run through some of these. I want you to break down what these companies actually do.
Sure.
In 2017, they bought Bureau van Dijk. What is that?
Bureau van Dijk is a massive database of private company intelligence. So if you are a bank trying to understand the corporate structure of a private entity in Europe, including who actually owns it and its financial health, you use their platform. It was a huge move into private market data for them.
Okay, got it. Then in 2020, they acquired RDC. The memo says this brought them deep into the compliance and KYC space. Now, for the listener, KYC stands for Know Your Customer. But what does that software actually do in practice?
No, your customer and anti-money laundering laws are incredibly strict globally. If you open a bank account, or if a massive corporation signs a new vendor, they are legally required to ensure they aren't doing business with a sanctioned entity, a terrorist organization, or a politically exposed person who might be involved in corruption.
Right, you can't just take money from anyone.
Exactly. So RDC provides the massive, constantly updated databases and screening software that automatically checks millions of names against global watch lists.
That sounds absolutely essential. You literally can't run a bank without that.
You really can't.
Okay, then in 2021, they bought RMS, pushing them into climate risk and natural catastrophe modeling. They added a company called Predicate in 2024. And just recently, in early 2025, they acquired KP Analytics, adding AI-powered geospatial property risk intelligence. That's a mouthful. How does an insurance company use something like KP?
This is a great example of modern risk modeling. Historically, if an insurance company wanted to underwrite a policy on a commercial building or a home, they might have to send an inspector out in person or rely on outdated tax records.
Which takes forever.
Right, slow and expensive. KP Analytics uses artificial intelligence to analyze high-resolution satellite and aerial imagery. Within seconds, it can assess the condition of a roof, the exact distance of trees to the structure for wildfire risk, or even the presence of a swimming pool.
Oh, wow.
Moody's acquired this to embed that instant AI-driven property risk data directly into the workflow of insurance underwriters.
When you lay it all out like that, it doesn't look random at all. I mean, it's not like they woke up one day flush with cash and decided to buy a social media platform or a streaming service or try to build smartphones. Every single acquisition is a tool that someone somewhere uses to measure how dangerous a financial decision might be.
The term we use for this is strategic adjacency. It is the opposite of conglomeration. They aren't building a messy, disconnected empire. They historically buy businesses that strengthen data, compliance, and insurance risk workflows. They aren't chasing vanity projects just to get in the news.
Right.
They're building a really comprehensive ecosystem around customer decision-making.
And I noticed in the memo that they also show a rare and frankly pretty commendable willingness to prune the portfolio.
Yeah.
They sold off an asset called Learning Solutions, and they are currently planning to divest the MA Regulatory Solutions business.
That is a crucial indicator of management discipline. It is very easy for a corporate executive to buy companies just to make their empire look larger. It takes a lot of discipline to admit when an acquired asset no longer fits the core strategy and to sell it off. It shows their focus on return on capital, not just gross revenue size.
They're also navigating some pretty significant leadership transitions right now, right? In the analytics division, Stephen Telenko departed, Andy Frepp stepped in as interim leader, and now Christina Kosmowski is taking over as the permanent CEO of Moody's Analytics in June 2026.
That transition is critical to monitor. As we discussed, MA is the growth engine that the market is relying on to justify that high software multiple.
Right, the pressure's on.
Exactly. The execution burden now shifts entirely to a new leader in their most important division. But overall, when you synthesize the memo's historical assessment, it is quite favorable. The company's past capital allocation suggests that their future decisions will likely remain rational, shareholder-aware, and strategically coherent.
Okay, so that is a very solid bull case for management. But we promised the listener we would look at the tail risks, the structural vulnerabilities. And you just cannot talk about the history of a ratings agency without talking about its darkest chapter. I'm talking about the 2007 to 2009 global financial crisis.
It is the unavoidable shadow hanging over the industry. And it raises a really fundamental question about the permanence of institutional trust. The absolute core of Moody's moat is institutional acceptance. It is the global belief that their ratings actually mean something.
Right.
During the lead-up to the subprime mortgage crisis, there were massive systemic credibility failures across the structured finance ratings sector. Agencies, including Moody's, assigned top-tier AAA ratings to complex mortgage-backed securities that were, in reality, incredibly toxic.
And when those securities blew up and nearly took down the entire global banking system, the ratings agencies paid a heavy price. The memo notes the 2017 settlement with the Department of Justice in various states, which cost Moody's nearly $864 million.
A huge sum.
That is a staggering amount of cash to hand over in a penalty. But honestly, looking back, the financial hit almost seems secondary to the reputational hit.
The financial penalty was a one-time charge they could absorb. The reputational damage was the true existential threat. It serves as a sobering reminder of a fundamental reality in this business model. Credibility failures in the ratings oligopoly are low frequency, but extremely high severity events.
Meaning it doesn't happen often, but when it does, it can just blow a hole in the side of the ship.
Exactly. Oligopoly status, dominating a market alongside S&P does not eliminate catastrophe risk if institutional incentives weaken or underwriting standards drop.
Right.
The franchise ultimately survived the 2008 fallout, and they managed the litigation overhang over multiple years, but it proved that historical trust can be permanently scarred. Reputational capital is something you build over a century, but you can damage it severely in a single, reckless economic cycle.
So, connecting the dots here, how does that history tie into this massive software and analytics transition they are making today? Why does the 2008 crisis matter when evaluating their new AI tools?
Because the transition to becoming an integrated risk platform is heavily, almost entirely acquisition-mediated. They are buying their way into these new markets. Let's look at the balance sheet as of March 31st, 2026.
Oh.
Moody's is carrying about $6.37 billion in goodwill and roughly $1.81 billion in net acquired intangible assets.
I want to make sure everyone understands those terms because they are crucial to understanding a balance sheet. Goodwill is an accounting term. It basically means the premium a company paid over the actual fair market value of the physical assets of the companies they acquired.
Right.
If I buy a famous local bakery for $1 million, but the ovens in the building are only really worth $500,000, that extra $500,000 I paid goes on my balance sheet as goodwill. It's the price of buying your way into a market, buying a brand name, buying existing customer relationships.
That is a perfect explanation. And the fact that Moody's has over $6 billion in goodwill means that a significant portion of their reported progress in the analytics space isn't organic, self-evident growth that they built from scratch in an R&D lab it was purchased.
They bought it.
Exactly. The history proves management is currently rational and disciplined in what they buy. But because their growth relies on acquisitions, it doesn't guarantee the next phase of growth. Things like AI distribution or digital finance will have the same inevitability or the same high returns as the last phase.
Buying companies is easy, relatively speaking. If you have the cash, or if you can borrow the cash, you can buy the asset. But making those acquired products indispensable to the customer, building a moat that competitors can't cross, that is the really hard part. Let's talk about the moat. I want to know where this fortress is actually impenetrable and where it might be vulnerable to technological disruption down the line.
To truly understand the moat, we first have to look at the sheer, staggering scale of the operation on the ratings side. According to the memo, in 2025, Moody's rated $6.6 trillion of debt.
Trillion. With a T.
Trillion. To put that in perspective, that was an all-time high. And the momentum didn't stop. In just the first quarter of 2026, rated issuance exceeded $2 trillion for the first time ever in a single quarter.
That is just an unfathomable amount of money flowing through their systems. They're functioning as the gatekeepers for the global economy. If a major corporation or a sovereign government or a massive infrastructure project wants to borrow money at scale, they essentially have to go through Moody's or their main rival, S&P.
And that reality forms the strongest part of the moat: embedded regulatory and institutional acceptance. The ratings oligopoly remains incredibly powerful because issuer workflows, investor mandates, and global regulations all reinforce incumbent scale.
Can you break down what an investor mandate means in this context?
Certainly. Think about a massive state pension fund managing hundreds of billions of dollars for retired teachers or firefighters. By law, or by their own strict internal charters, they are often only allowed to invest in investment-grade bonds.
Okay, and who decides what that is?
Well, how do they define investment grade? They explicitly require a rating from a nationally recognized statistical rating organization, which primarily means Moody's or S&P.
Ah, I see. So a new, brilliant tech startup can't just build a better credit risk algorithm in a garage in Silicon Valley and replace Moody's. Even if the startup's math is arguably better, the pension fund isn't legally allowed to use it. The global financial system's plumbing is fundamentally built to require a recognized legacy rating.
Precisely. That is why the ratings moat is virtually impenetrable by traditional disruption. It is legally and institutionally enforced. But the analytics side, the software side, is a different story. Software can be disrupted by better tech, so we have to examine the moat there.
And the memo argues that the analytics moat is built differently. It's built on switching costs. Let's look at how sticky this software really is. The recurring revenue in MA is remarkably robust. As of March 34, 2026, MA's annualized recurring revenue, which they call ARR, reached $3.61 billion.
Right.
If we break that down by division in Q1 2026, they had $706 million in insurance ARR, $473 million in KYC compliance ARR, and over $1 billion in general research and insights.
The numbers are impressive, but the retention rates are the real indicator of the moat. The memo notes that the trailing 12-month retention rate for their insurance software products hit 97% in Q1 2026.
97%. That is an astonishing metric.
Yeah.
I mean, if you are a software CEO and your retention rate is 97%, you are sleeping very soundly at night. That means out of every $100 of subscription revenue they had last year, $97 automatically renewed this year. Once these products are integrated, companies just do not rip them out. Why is that? What is an insurance underwriter actually doing that makes them so dependent on this software?
It comes down to deep operational embedding. In KYC compliance and insurance risk modeling, you have massive data integration switching costs. Let's go back to the KPE Analytics example we discussed earlier, the AI satellite imagery.
The pools in the trees.
Exactly. An insurance company doesn't just buy that software and look at it on a separate screen. They integrate the APIs, the software connections, directly into their proprietary internal underwriting engines. Thousands of employees are trained on it.
So it becomes part of their DNA.
Right. If a bank or an insurer wants to switch to a cheaper competitor, they have to tear out the plumbing of their entire IT system, retrain thousands of employees, and halt operations during the transition.
And presumably, there's a massive personal risk for the executive making that decision. If I'm the chief compliance officer at a global bank, I'm using Moody's RDC platform to check for money laundering. I know it works. If I decide to switch to a cheaper startup to save the bank a few $1 million, and that startup's database misses a transaction from a sanctioned entity, The bank gets hit with $1 billion fine and I lose my job.
It's just not worth the risk.
You don't swap out core compliance software to save pennies when the downside risk is catastrophic.
Exactly. The perceived risk of switching far outweighs the financial cost of just paying the annual subscription increase to Moody's. That is a phenomenal moat.
But there is a fascinating nuance in the memo regarding their sales strategy. They aren't just selling to anyone and everyone. They are heavily focused on expanding within their largest existing accounts.
Yes, that's key.
The memo highlights multi-year deals with two of the world's 5 largest asset managers. Management actually noted that their largest strategic customers contributed over 30% of the total MA net growth in Q4 2025. And those top customers are growing at twice the rate of the rest of the customer base.
From an operational standpoint, it is a brilliant strategy for efficiency. Expansion within large existing accounts is usually much higher quality revenue than volume chasing new logos. It costs significantly less in sales and marketing to sell an additional module to a bank that already uses you than it does to convince a brand new client to sign their first contract.
I see the efficiency argument. But wait, isn't customer concentration a double-edged sword? If your best growth, your juiciest margins, are entirely dependent on selling more and more to a handful of top-tier asset managers, your execution has to be absolutely flawless.
Right.
If you mess up a major product update or if the system suffers massive downtime, you aren't just frustrating a small regional bank, you are jeopardizing your most vital growth engine.
That is a very sharp observation, and the memo explicitly flags this as a quiet concentration risk. When your most strategic use cases are driving the bulk of your expansion, product quality, uptime, and distribution partnerships matter exponentially more. A few execution misses at the top end of the market can have an outsized, devastating effect on the overall growth narrative.
So if we synthesize all of this about the moat, it sounds like the fortress is thickest, where the regulations are the strictest, and where the integration is the deepest.
That is the core takeaway. The moat is strongest where Moody sits inside regulated, legally defensible, auditable decisions. However, it is fundamentally weakest in their lower-end research and generic data provision.
Because that is the area where AI is most threatening. Right?
Exactly. The lowest barrier to entry in their business is pure information synthesis. If a product simply involves gathering publicly available financial data, summarizing it, and writing a report, generative AI models can increasingly do that cheaper, faster, and in greater volume.
They can automate it.
Right. But if the product requires a legally defensible compliance decision where an auditor is going to ask, why did you approve this transaction? AI cannot simply replace the Moody's stamp of approval. Not yet, anyway. The institutional trust remains the ultimate barrier against technological disruption.
So we have established a massive, albeit nuanced, moat. We have incredibly sticky software products embedded in the daily workflows of global finance. Let's talk numbers, because this is where the rubber meets the road for investors. Spoiler alert for the listener, they are making a staggering amount of money.
A truly staggering amount.
But what are they actually doing with all that cash? Let's pivot to financial quality, capital allocation, and the real tension of this memo, the valuation disconnect. Why does management's strategy for allocating capital matter so much for long-term value creation, especially given the stock price today?
It matters deeply because capital allocation is the ultimate lie detector test. It proves what management truly believes internally, regardless of what they say externally on earnings calls. But first, let's establish the sheer strength of the financial fortress they operate from. The operational execution over the last few years has been exceptional.
Let's hear the numbers.
Look at the revenue trajectory. Consolidated revenue went from $5.92 billion in 2023 up to $7.09 billion in 2024 and reached $7.72 billion in 2025.
And what's impressive is that it's not just top-line revenue growth. They're getting more efficient as they grow. They're squeezing more actual profit out of every dollar that comes in the door. Adjusted operating margins have expanded aggressively. We went from roughly 43.9% in 2023 up to 48.1% in 2024 and hit a whopping 51.1% in 2025. Over half of their revenue is turning straight into operating profit.
And when you break that down by segment, it's even more dramatic. The first quarter of 2026, the MIS segment, the rating side, reported an adjusted operating margin of 66.7%.
I just want to pause on that number, 66.7%. For listeners who operate in physical world retail manufacturing restaurants, a 10 or 15% profit margin is considered fantastic. A 66% margin is almost unheard of in traditional business. How is that mechanically possible?
It is possible because the business possesses incredibly limited capital intensity. They don't have to build massive physical factories, they don't have to buy raw materials like steel or oil, and they don't have complex physical supply chains.
Hmm.
Their primary expenses are human capital analysts, data scientists, software engineers, and computing power. Once the analytical framework is built and the brand is established, the marginal cost of rating one additional billion-dollar bond issue is virtually zero. It is pure intellectual property scale.
Which naturally translates into a geyser of cash.
Hmm.
Free cash flow rose from $1.88 billion in 2023 to $2.58 billion in 2025. The business clearly earns returns far above its cost of capital. So they have $2.58 billion in free cash flow burning a hole in their pocket at the end of the year. What do they do with it?
This is exactly where the skeptical framework of the memo kicks in hard. They're returning roughly 110% of their free cash flow to shareholders by year end. In just the first quarter of 2026, they returned $1.7 billion through stock buybacks and dividends.
Right.
The board had authorized a massive $4.0 billion share repurchase program in October 2025, and they had about $2.5 billion remaining by March 2026.
Okay, I'm going to push back here because if I'm an investor holding Moody's stock, I love buybacks. When a company buys its own shares and retires them, it reduces the overall share count. That means my remaining slice of the pie just got a little bit bigger. Earnings per share go up. Warren Buffett loves buybacks when the math makes sense. So why is the memo painting this as a negative?
The crucial part of your defense was when the math makes sense.
Okay.
The problem here is the price they are paying for their own stock and what that signals about their internal view of future growth opportunities. At roughly $434.49 per share in May 2026, Moody's was trading at about 31.2 times trailing earnings.
Right, going back to the multiple we discussed earlier.
Yeah.
You are paying 31 years worth of current earnings to own the stock today.
Correct. And let's compare that to the broader market. S&P Global, their main rival, was trading around 26x. FactSet, a pure financial data player, was down at 14.3x. Furthermore, Moody's free cash flow yield, which is simply the free cash flow per share divided by the stock price, is hovering near a very meager 3.3%. You could arguably get a higher yield pending a risk-free government bond.
So they're buying their own stock at a massive, massive premium.
Precisely. And here is the core contradiction in the corporate narrative, the lie detector test I mentioned. Management is externally claiming on every earnings call that they have an enormous reinvestment runway. They are touting massive future growth in AI, in private credit, in digital finance.
Yeah.
If those opportunities are truly as vast, untapped, and high returning as the narrative suggests, the absolute best use of that $2.58 billion in cash would be to reinvest it aggressively into the business to capture those new markets.
I see the trap. You can't talk out of both sides of your mouth. You can't look investors in the eye and say, we have the greatest growth opportunities in the history of financial data right in front of us, and simultaneously say, we can't find anything better to do with our cash than buy our own stock at near all-time highs of 31 times earnings.
Exactly. Returning 110% of your free cash flow is a sensible, prudent strategy for a mature, slow-growing franchise like a utility company or a legacy consumer brand that has run out of new markets to conquer. But aggressively buying back stock at 31x trailing earnings fundamentally contradicts a high-growth narrative.
It just doesn't add up.
One of those claims is likely being overstated. Either the internal reinvestment runway isn't actually as lucrative as they claim, or they're actively misallocating capital by buying expensive stock instead of funding that growth.
And when you see contradictions like that, it makes you wonder about the incentives driving these decisions. Are the executives being paid to make the company fundamentally better and more resilient for the next decade? Or are they just surfing a massive wave of macroeconomic luck to maximize their bonuses this year? Are they paying for actual performance, or are they just getting lucky with the market?
The memo dives into the proxy statement to find the answer. The governance mechanics on the surface are actually quite robust. They require executives to retain 75% of their net shares until ownership targets are met. They have strict anti-hedging policies and strong clawback provisions if financials are misstated.
That sounds good.
But the incentive calibration, how they actually hit their bonus targets, is revealing. The 2023 to 2025 performance shares paid out at 159% of target.
159%. That is a massive payout. Did they invent a new color? Did they discover cold fusion in the basement of the analytics department? What drove that level of outperformance?
What primarily drove it was a cyclical rebound in the macroeconomy. Remember, 2023 to 2025 saw a massive recovery in capital market conditions after a period of rate hikes. When debt issuance spikes, Moody's ratings revenue skyrockets almost automatically because the toll road gets busy again.
Right.
So 159% payout isn't technically outrageous given the reported financial results, but it reflects what we call pay for beta, getting heavily rewarded for favorable macroeconomic tailwinds just as much as it reflects pay for performance or self-generated operating excellence.
They happen to be standing outside with the bucket when it started raining cash.
Pretty much.
And let's not forget how they achieved some of those incredible 51% operating margins. It wasn't just effortless scaling of the software. The memo points out they pushed through massive corporate restructuring programs. They had a 2022 to 2023 program targeting up to $165 million in annual savings. And then, not satisfied with that, they approved a 2024 program expected to generate another $250 million to $300 million in annualized savings.
Which is undeniably a positive for short-term efficiency. But it serves as a critical reminder for investors projecting these numbers into the future. Some of these recent margin gains were engineered through cost-cutting, real estate footprint reduction, and layoffs, not just magical software leverage.
You can't just keep cutting forever.
You can only restructure and cut costs so many times before you hit the bone. You cannot cost-cut your way to infinite growth.
Okay, let's summarize the financial picture before we move on. We have a company trading at 31 times earnings. They are aggressively buying back their own stock at that premium valuation. They are rewarding their executives heavily for macroeconomic tailwinds, and they are engineering some of their margin expansion through repeated cost-cutting.
That's the picture.
To justify keeping the stock at a 31x multiple, the market is pricing in massive exponential future growth. So we need to look closely at the hype sectors management is selling to Wall Street to justify that growth. Let's unpack the hype around artificial intelligence and private credit and look at the disconfirming evidence. How do we separate the genuine growth drivers from narrative fluff, and why does this matter so deeply for downside protection?
Whenever a management team leans heavily on industry buzzwords to justify a premium valuation, a skeptical investor must rigorously look for the cracks in the narrative. Let's start with private credit. Management has been touting this as a massive structural driver for the future. They stated on record that private credit revenue rose 60% in 2025 and was up more than 80% year over year in just the first quarter of 2026.
80% growth in a single quarter is eye-watering. For context, what is private credit and how does it differ from the public bonds we've been talking about?
A traditional public bond is when a large corporation, like Ford or Apple, issues debt in the public markets, regulated by the SEC, with transparent financials available to everyone.
Very transparent.
Right. Private credit, on the other hand, involves non-bank lenders like private equity firms or specialized debt funds, lending money directly to usually smaller or mid-sized private companies. The terms are negotiated privately, the financials are often opaque, and the debt doesn't trade on an open exchange. It has exploded in popularity because traditional banks have pulled back from lending.
Okay, so Moody's is rating or modeling this private debt, and revenue is up 80%. That sounds like a home run. But here's where you really have to read the fine print in the memo. What does this explosive growth actually mean when the company's own 10K document, the legally binding, highly scrutinized filing they submit to the SEC, warns explicitly about regulatory attention and litigation risks in that exact same private credit space?
It means that private credit is exactly the kind of growth pocket a skeptical investor should view with the most distrust. Yes, it might be a durable adjacency that drives revenue for years, but private credit operates with far less transparency and standardization than traditional public debt. The 2025 10K explicitly warns of evolving liability standards, litigation risk, and increased regulatory inquiries related to private credit structures.
So they are chasing the hottest, fastest growing trend in finance. But that trend is largely untested through a severe, prolonged economic downturn.
Precisely. Private credit may prove to be the very place where regulators, litigation, or simply poor underwriting outcomes first crack the franchise's risk pricing discipline. If the economy turns and the private credit market faces a wave of defaults that were masked by opaque accounting, the entities that rated or modeled that risk will face immense scrutiny, echoing the ghosts of 2008.
And then there's the elephant in the room, artificial intelligence. It feels like every company on Earth is slapping an AI label on their products to get a valuation bump. Management is touting AI distribution and AI-powered analytics across their platform.
And we should acknowledge that AI absolutely sounds great for data distribution. If you are an analyst trying to comb through 500 pages of a corporate filing, an AI tool that synthesizes that information instantly is a massive productivity boost. It makes finding and packaging information faster.
But the memo points out a crucial limitation. Moody's acknowledges a severe regulatory sensitivity the moment AI crosses the line from being a research assistant to being a decision maker.
Exactly. The moment an AI model begins to make actual lending, underwriting, or credit ratings decisions, rather than merely accelerating the data gathering for a human analyst, the regulatory risk skyrockets.
Because if a complex black box AI algorithm makes a credit decision that turns out to be systematically biased or catastrophically wrong, who does the regulator sue? You can't put an algorithm in the witness box. You can't depose a neural network.
That is the fundamental friction. AI may strengthen the data franchise, it may make their internal human analysts more efficient, but it does not currently justify a materially higher terminal multiple for the stock. Think about the core identity we established. The moat of Moody's is auditable trust.
Right.
A regulator can look at a Moody's methodology and understand exactly how a human committee arrived at a rating. AI, right now, operates fundamentally as a black box. Those two concepts, audible trust and black box algorithms, are in direct tension.
This analysis leads us perfectly to what the memo outlines as the plausible disappointment scenario. And the scariest part of this scenario, reading through it, is that you don't need a massive operational failure for the stock to plummet. You don't need another 2008 financial crisis. You don't need a massive scandal for this stock to deeply disappoint investors who buy in today.
This is perhaps the most crucial takeaway for anyone evaluating the stock at current prices. The stock is currently priced for absolute perfection. What happens if things are just normal?
It's just average.
Imagine a multi-year period where macroeconomic conditions stabilize and debt issuance simply mean reverts to historical averages. It doesn't crash, it just stops breaking records every quarter. In that scenario, MIS, the ratings revenue, grows only in the low single digits.
And let's say the analytics side, MA keeps growing. Customers don't cancel, the retention stays at 97%. But instead of double-digit hypergrowth fueled by easy acquisitions, the law of large numbers catches up to them. The market matures, and MA settles into mid to high single-digit growth. It doesn't accelerate. It just becomes a mature, stable software business.
If that completely benign, normal scenario plays out, the market will inevitably re-rate the multiple. The stock would likely compress from trading at over 31x trailing earnings down toward the mid-20s, which is a much more typical and historically rational valuation for strong but not untouchable information franchises.
Let's do the math on that for the listener. If the underlying business continues to grow its actual earnings by, say, 5% a year, but the valuation multiple that investors are willing to pay drops from 31 down to 24, the stock price goes down. An investor could lose a significant amount of money over a 5-year period, even if Moody's remains a fundamentally excellent, highly profitable company. The business succeeds, but the stock fails.
Exactly. The margin of safety at this 31x valuation is virtually non-existent. You are paying a premium today that leaves absolutely zero room for cyclical normalization, zero room for regulatory friction in private credit, and zero room for any disappointment in their ability to flawlessly monetize AI. You are paying for a future that has to be perfect.
Okay, we have covered a massive amount of ground today, going from the bedrock of the skyscraper all the way up to the AI-powered penthouse. Let's pull it all together. If you take nothing else away from this deep dive, drive home these 3 key takeaways. First, Moody's is undeniably a phenomenal top-tier business with a virtually impenetrable regulatory moat. But make no mistake, its core bottom-line profitability remains deeply tethered to the highly cyclical ratings market, not just the predictable, recurring software narrative that the market currently loves to highlight.
Second, the management team has proven themselves to be competent, strategically disciplined in their acquisitions, and willing to prune non-core assets. However, their capital allocation decision to aggressively buy back shares at a 31x multiple materially reduces the margin of safety for any new investor stepping in today. It fundamentally contradicts their own narrative of having an endless, high-return reinvestment runway. And third, the growth narratives around AI and private credit are undeniably promising, but they are currently over-celebrated by the market. They carry significant and largely unpriced regulatory and litigation risks that are explicitly spelled out in the company's own legally binding filings.
Which brings us to the final verdict based on the rigorous, skeptical framework of this memo.
Mm.
Moody's is a high-quality franchise that is currently priced precisely like a high-quality franchise, leaving no room for upside surprise. The evidence simply does not justify committing fresh capital today at the current price. until the valuation becomes less demanding, or they definitively prove that the analytics segment can dominate consolidated profit without sacrificing overall margins. The right stance today is admiration without purchase.
Admiration without purchase. You can appreciate the brilliant architecture and the sturdy foundation of the skyscraper without needing to buy the penthouse at the absolute top of the market. But I want to leave you, the listener, with a final thread to pull, something to mull over that goes beyond today's balance sheets and operating margins. We talked extensively about AI commoditizing basic data gathering. Think about this. If AI eventually becomes so incredibly advanced that it perfectly commoditizes the gathering, synthesizing, and complex risk modeling of financial data across the entire industry, if it makes the actual predictive math identical and accessible for everyone, does Moody's century-old brand reputation become their only true remaining moat? And if so, when math becomes a commodity, how much is pure trust really worth?